Hey everyone, welcome again to another financial analysis video. I'm Moeed Amin and I'm joined by my co-host Ted Wayman. So today we're going to be looking at a well-known company when it comes to semiconductor manufacturing. Slight misconception there, which I'll come on to in a moment. So we're looking at ASML today. Now remember, for all of our viewers, particularly if you're a new viewer to our channel, firstly, welcome to our channel. The purpose of this show is to help you raise your financial acumen, your financial knowledge, so that you'll be able to analyze financial reports, whether they're annual reports or quarterly statements, and help you when it comes to whatever aspect you're looking for in these companies, whether it's investing, whether you're selling to these companies, whether you're joining these companies and you have an interview with them, or even if you have ambitions for your career, and financial knowledge is a very big part of that. As Warren Buffett said, finance is the language of business. So it stands to reason, if you can't speak the language, then you can't really do business properly. So do like, share, subscribe, and we'll share some more videos for you based upon your request. So ASML, let's talk about ASML and what they do. Now, I talked about misconception here. A lot of people misconstrue that they actually make chips, right? They're chip making manufacturer. Not true. Actually, they make photolithography systems. So basically what that means is they're the only company in the world, according to my research, that actually is able to make the machines that help chip manufacturers like Intel, etc., make their chips. So they're in a really privileged position when it comes to market capitalization here. Now, they were founded in 1988 as a joint venture with Advanced Semiconductor Materials International and Philips, both Dutch companies. Therefore, ASML is a Dutch business. They became independent in 1980. Sorry, it was in 1984 they were founded. In 1988 they became independent, and Philips still holds about 25% of its shares. Now we're going to talk about the share price later on as part of the context for the financial analysis we're going through. But just a note on the share price very quickly. They floated in 1995. If you had invested back then, you'd be sitting on a pretty profit of 18,000%. Benefit of hindsight, as always. You invested 5 years ago, you'd be up 221%. If you invested a year ago, you'd be down 16%, as with a lot of companies out there, particularly in the technology sector, that are down. So we're going to come on to that later on, so do stick around. Now, this video was, this company was a request from one of our viewers. So Roald, here is your video. Thank you for your request. And of course, if you have a company you're really interested in and you would like us to analyze for you for whatever reason, do leave a note in the comment section. Give us a bit of context. The more context and the more interesting, the higher likely you're going to be prioritized. But if you're a subscriber, you will get instant notification when we publish the company you're interested in. So do make sure you subscribe and hit that notification button. So without further ado, Ted, let's share with our viewers what we uncovered about this business through its financial statements.
Yeah, good to see you, Moeed, and hello to all of our viewers. Once again, as Moeed said, please do remember to subscribe to the channel. And that will really help us as well as helping you. So please do. So here we are, annual report. So ASML, their annual report 2021. Now there are some updated figures on their website, quarterly and half yearly. We're not going to be looking at those. If you want to look at those, you can, but we're going to give you an idea of where to look and how to read them in their 2021 annual report. And this will tell you all about who they are and what they do. So those of you who are regular viewers, regular subscribers to the channel, know by now that we whiz down through the kind of the detail about the strategy and the corporate governance and the risk and the kind of who's on the board and all that kind of stuff. And we go down to the core numbers. So here we go, and we're getting close to it, the financial statements, and we're looking at the income statement, which they call the consolidated statement of operations. So here we are on our consolidated statement of operations, ASML 2021. First thing we notice is that we are dealing in euros. Okay, so there we go. It's in euros and it's in millions of euros. So when we get the revenue of 12 11,820. 11,000 million is 11 billion. So it's about 12 billion euros. You also notice that the column I'm looking at is 2019. Now, most of the companies we've been looking at, they put the latest set of figures on the left and comparative on the right. These guys, they're going to do it the other way around. So we need to make sure that we're looking at the correct column, which is on the right and is in bold. So we can see in 2021, they've got sales of 18.6 billion. So a significant increase. That's a 33% increase on 2020, which in itself is an increase on 2019. So these guys are growing, and they are growing pretty rapidly. So pretty impressive results coming through from them. Looking at the costs of, they've got then the cost of sales, the cost of actually making those kind of boards for, you know, the and I quite like the idea, Moeed. This is a kind of a picks and mortar kind of, so a gold picks and shovels and picks. That's it, shovels and picks. So when everybody went out to find gold, the people who really made a lot of money were the people who were selling the picks and shovels to help them find the gold. And these guys, you know, obviously the chip manufacturers are making money, but these guys are making money just by providing the kind of the stuff for them to make those chips. So really very, very profitable business. There we go. The gross profit margin is over 50%, which means that every dollar they bill their client, it only costs them 47 cents to make that product, and therefore they get to keep 53 cents. Pretty good. Quite interesting here, the SG&A, the cost of running the business, relatively low, 725 million. So they're a pretty lean company. And Moeed, you and I have come across some pretty fat companies in our time. And what you'll notice here is that they're not being complacent. So as well as the SG&A, the kind of the overheads, the cost of running the business, there's a big R&D cost investing in the future. They realize they can't stand still. The world is changing. Microchips, I forget whose law it is, you'll probably remind me, where chips double in capacity or processing power every 18 months. It's kind of, it's Moore's law or Boyle's law or something. Yeah. Whose is it?
Yeah, Moore's law.
Moore's law, that's it, Moore's law. Yeah. So Moore's law saying that they're, you know, and that's kind of, you know, so this big R&D is a kind of a very clear signal to the investors that these guys, you know, are not complacent. They're not taking their foot off the gas. Yet they are still, after a little bit of interest, suggesting they've got a little bit of debt and paying tax because they are profitable, they're still making a nice, healthy bottom line, 5.7 billion euros on a 18.6 billion turnover, 32%. That's a pretty significant profit margin. We don't see many companies up at there. Facebook, I think, is kind of at that kind of level. Even Coca-Cola isn't there. They're up at about 20%, but anything over 30% is really pretty massive on 18 billion turnover. So what do we think? Looking pretty nice. We like you know, very, very profitable and rapidly growing company. And you'll notice it, and we'll just point it out now, that their income per share. Okay, so this is basically the net profit. That's this figure here, divided by the number of shares in issue, because sometimes companies are buying back their shares or issuing shares. So it's quite a nice way of just looking at, you know, as a shareholder, your share of the profit has gone up from basically 8.5 euros to 14.4 euros effectively. So you know, substantial growth going on within this organization, looking pretty good. Let's look at the balance sheet and see how the kind of the strength of the company sitting behind them. Don't forget, we can often have profitable companies which are kind of looking a bit shaky behind. So their total assets are these two. Total assets 30 billion. We've got the current assets of 18 billion. So these are the things which they own, which are either cash or going to become cash soon. You'll notice that they've got cash up at the top. So they've got 7 billion in cash. They've got 3 billion of accounts receivable, and they've got another 5 billion of inventory. Now that inventory looks pretty high to me. They're turning over 18.6 billion, and their inventory is sitting at about 5 billion. by my calculations, and this is very much back of an envelope calculation, takes them 202 days to sell their product, those circuit boards, and that sounds to me like quite a long time. Now, I don't know the reason for that, whether there's a particular reason that they hold relatively high amounts of inventory. I don't think it's a massive issue for them because they've got lots of cash and they're very profitable. So, maybe they're just saying, look, we can afford to do that. But in a rapidly changing world, you don't want to hold too much inventory because some of that inventory might become obsolete. Anyway, so a lot of inventory, but a lot of current assets, 18 billion. The non-current assets, actually, interestingly enough, lower than the current assets. They've got some goodwill. That's the biggest number on the sheet, the big goodwill, and that suggests that they have grown through consolidation or acquisition, as you were mentioning earlier. And they've got some property, plant, and equipment, and they don't need a huge amount. They've got about 3 billion, which is a fair amount, but they don't need a huge amount. They can rent a lot of offices. They'll obviously have some sort of fairly high technical equipment for kind of actual manufacturing, but it looking to me that what they're producing is pretty high-end technical expensive stuff, so they don't need big amounts of infrastructure. So interesting enough, these guys, they've got a lot more current assets than they do than their non-current assets. Okay, and if you look at, I don't know, an energy company is going to be all here with a little bit here. If you look at BMW, it's all about their kind of manufacturing with a little bit up here type of thing. So there's the assets. Let's go and have a look at the liabilities, see what that is telling us about our business. So here are the total liabilities. We'll just scroll down so we can see them. There they go. So we've got some current liabilities. That's what they have to pay within a year. Interesting enough, they got some contract liability. So this is kind of so their accounts payable is only 2 billion, but they've also got some, they're in the middle of a contract. They're making stuff. They haven't been billed for it, and so they owe their suppliers. So that's quite an interesting one. But it's only 12 billion, and 12 billion compared, if you remember, their current assets were 18 billion. So liquidity is not looking an issue for these guys. And they've got some debt in the long-term liabilities. There it is. There's the debt, and we can also take that debt and we can add it to their current portion of that debt. And again, we've discussed this before, but just so we're clear, if you have a mortgage, for example, most of your mortgage will be long-term, this number here, but a little bit of your mortgage you're going to have to pay next year, also next month and the month after that, so it'll be current. So that's not a problem. And you'll notice that that debt is, if you compare it to the previous year, it's gone, I don't know, it's gone, it's pretty much the same actually. So it hasn't really moved that much. 4.6 down to 4.5. It just means that they've got a little bit more which is falling due and a little bit less which is long term. Not a problem for these guys because they're going to refinance their debt. So what we'd expect them to do, just go to the bank, say, look, can we borrow some money to repay a loan? So liquidity
I would say it's moved down quite a bit though, right? I mean, it's 4.075, so it's about 600 odd million.
Yeah, no, sorry, mate, I wasn't clear, and thanks for pulling that up. What I'm doing is I'm comparing this number plus this number as the total amount of debt. Yeah, is 4.7 billion, and if we compare it to the 509 and the 4075, which is 4.6 billion, actually it's only gone down by 0.1 billion, so it's not substantial. So when we look at debt, we need to kind of bring the short-term and the long-term debt together so that we're getting that full picture. But thanks for picking that up and allowing me to clarify that. So there's the debt. So, really balance sheet looking pretty strong here. So the shareholders' equity, the total liabilities, 20 billion, total assets are about 30 billion. And therefore, we've got the total shareholders' equity is the balance of 10 billion down the bottom here. And the most of that is this retained earnings. So these guys, they've been making profits. Those profits have been reinvested back into the business. You'll be interested to notice, though, that even though they made a big profit, the retained earnings has gone down. So that suggests, why have they done that? Well, it suggests to me they've probably paid a dividend or done a big share buyback. And we will be able to see that in the movement in equity. So let's go look at the movement in equity, see what's going on there, what's going on, why they're doing that. And we will notice from the movement in equity, Let's find the numbers. Here we go. So 2019, 2020. So from 2020, for example, there's the profit figure. Yeah, so here's the profit figure they're making. So they're making a 5.8 billion profit, 5.9 billion in profit. They start with 10, they make 5.9 billion. Now, interestingly enough, we need to kind of read these numbers together. This is share buyback. So what they've effectively done is that they've bought their shares back, and then they've cancelled those shares, and they've cancelled them against those profits. So this is a company, they're paying a little bit of dividends, yes, but the main use of those profits has been the share buybacks. And this is not limited to this particular year. We can see that in the previous year. So we just scroll up again, the previous year, they made a 3.6 billion euro profit. They paid out about $1 billion in dividends, but there is this share buyback going on. So they're buying back their shares, they're cancelling those shares. Now, a little bit of difference here. So if you look on someone like Coca-Cola's balance sheet, you'll see they're carrying a significant amount of treasury stock. So what Coca-Cola are doing, they're buying the shares, but they're not cancelling them. These guys, they are buying them, and then they are cancelling them. It's more of an accounting and treatment than anything else. It doesn't really kind of make too much difference to our reading of the company. But these guys are cancelling them, which means that they can't reissue them, and without kind of going through the kind of the creation steps that they need to go through. Anyway, so we've got a company who's out there, they're buying back their shares. And if they're buying back their shares, you would expect their share price to be going up. Now, if they're profitable and they're doing very well, and they're growing, you'd expect it to be going up. And if they're buying back their shares as well, then you should see some exponential growth in the value of those shares. Here's their cash flow statement. Cash flow statement, you remember, Moeed, this is my favorite number here. The cash generation. So yes, they are making a profit of 5.9 billion, but they are generating lots and lots of cash, $8.9 billion. Okay, so this is really important number. Very, very cash generative business, and it's good to be generating cash, because if you're not generating cash, you're losing cash, and if you lose cash for long enough, you will go bust. As a few of those companies we've been analyzing to date are probably going to experience over the next couple of years. So what are they doing with that cash that they're generating? So the first thing they're doing is investing. Now that's 72 million, pretty small number. So what we see here is that there's a little bit of buying and selling short-term investments. Now you may remember that these investments here, this is just parking cash. So this is a kind of another way of using your cash. You buy an investment, you're not really investing in the company. It's a bit like you and I just putting money in the deposit account, but because of accounting rules, you've got to account for it as an investment, not as in a kind of movement in cash. So it sits in this bit here. So I would strip that out and really focus on this number up here. That's your capex, okay? Property, plant and equipment. And what we quite like to do, we'll just do that now, is we like to just compare that figure to the depreciation. So you'll notice for these guys, depreciation 471 million, not a massive number. It's not a big number because they don't have a lot of assets, as we discussed earlier, and they are buying 900. So if you're depreciating your existing asset base at 471 and you're buying 900, it means you're growing your business. So this is the reflective of a company which is growing rapidly, and they are investing, which is good. Okay, not necessarily the signal you get from that 72 million, which means we've got to pick apart, we've got to dig a little bit deeper. Here is the financing, and we notice here's the dividend that is paid. And then in terms of their debt, there's a net debt repayment. So they're actually giving a kind of a net debt repayment. And these numbers here together are kind of showing that the refinancing. So often we can take these numbers to go, are they raising debt? Are they lowering debt? And these guys, there's just a little bit of there's not a lot of movement. All that's happened is that some of their long-term debt has now been reclassified as short-term debt and is going to be repaid. And I would, bet my bottom dollar that if we get to next year's cash flow statement, we're going to see that 500 million being refinanced. That's my guess. Although they may choose not to, they got a lot of cash. They may choose to use some of that cash to pay down their debt. Anyway, so net effect is that they have an increase in cash of nearly $1 billion. They start with 6 and they finish with 7, and that's effectively accounting for that increase in cash. So these guys, you know, what is the cash flow telling us? It's telling us that they're generating a lot of cash. They're using that cash to invest, some of that cash to invest, but most of that cash is being returned to the shareholders, and it's being returned through the purchase of their own shares, which they are then cancelling. So that has been a big driver of the share price over the last few years. So if we go and look at the share price now, this is something which I always fall foul of. So I've made a conscious effort not to fall into my own little trap this time, Moeed, is that the dollar, this share price, this is quoted for us in dollars, but of course we've been looking at all the figures are in euros. So when we talk about the shareholder, the value of the company, market cap down there says 220 billion. Actually, we need to think of it as in 210 billion euros, 220 billion dollars, 210 billion euros. Okay, so very, very close, but not exactly the same. Anyway, it's a P ratio of 40 times. 40 times earnings. That's a pretty low yield. That's just over 2% yield. However, this company is growing rapidly. Dividend yield is very small, mainly because they're doing all these share buybacks, and maybe they're looking at their share price and thinking, gosh, we're a little bit off the scale, a little bit off the charts, everything's tanking down. Maybe we shouldn't have been buying back our shares at such high prices. However, I think that share price fall is more of a reflection of the market as a whole rather than these guys individually. And what I would just say is that, and we don't often talk about this, Moeed, so I'll mention it here, that we talk about PE ratios, but there's another metric called the PEG ratio, which is the price to earnings growth. And there what we're looking at is the growth in the earnings per share. So you may remember when we were looking at the income statement, and I'll pull up the income statement now. Here it is. So down the bottom of the income statement, I highlighted this earnings per share and how it had grown from 8.49 to 14.36. Okay, now that is a 70% growth. Okay, so that's a pretty significant growth rate. And therefore, if you assume that that growth rate is going to go into the future, then the earnings, you can start to see these earnings here, the net income from 3 billion, sorry, 2.5 billion to 3.5 billion to nearly 6 billion. You know, if that continues, then actually this becomes a really, really attractive business. So even on a high 40 times earnings, if they can sustain, and that's the big if they can sustain that, then these look relatively cheap if you can forecast, if they can maintain that rate of growth. Okay, so yes, on a price to earnings basis, they look expensive, but on a price to earnings growth rate, and I've calculated a PEG ratio of 0.52, then they look pretty cheap. And then if you start to, you can also start to think about dividends and yields, etc., and again, they're looking, not expensive. Makes sense.
And Ted, just for a benefit of our viewers, just in case they don't know, anything below a 1 on the PEG ratio means it's attractive. Anything above 1 means that it could be expensive.
Absolutely, yeah. So yeah, and again, it is very much a forward-looking, and as we talk about all the time, markets are forward-looking, financial analysis is backward-looking. So all we're trying to do is to look backwards at a company and then predict what's going to happen in the future. And I guess we kind of liken our financial analysis a bit like opening the bonnet of a car and saying, is the engine running? Does it look good? That doesn't, necessarily say it's going to perform very well in the track or it's never going to go wrong in the future. We're just saying what we've got right now is, we've got a profitable company. We've got a strong balance sheet. It's got lots of cash. It's investing in the future. It's got its market pretty much tied up. Things are looking pretty good. However, who knows what kind of challenges and headwinds and and whether, you know, what the competition is like. And I don't know anything about that. So if any of our viewers have got some insight about, you know, there's no competition for these guys, buy, or actually, you know, their time is up and they're about to do a BlackBerry, for example, and get pushed out of the way by a new entrant, then, you know, do let us know in the comments. I'm always interested to find out the thoughts of our viewers on these companies.
Yeah, and particularly with chip manufacturers and the supply chain issues that they are facing, this is going to be an interesting one. So if anyone has any insights on there, please, as Ted said, do leave a note in the comment section. This is a community at the end of the day, and we're here to educate each other and raise each other's awareness and financial acumen. So thank you, Ted. That was very interesting for a very interesting company. And hopefully Roald got some value from that. I'm sure he did. And if he has any questions, he can leave those notes again in the comment section. So until the next video, thank you, Ted. Thank you, everyone else. We will see you on the next analysis.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to, you know, ask questions. And do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.